Good afternoon. Todd Engelhardt, Regional Director of Investments, Cumberland Advisors, standing in for Matt McAleer. It is Friday, March 24, shortly before the close. I am joined by fixed income analyst and portfolio manager Shaun Burgess, my colleague. Shaun, we had a very interesting equity trading week. We got off to a very good start. Monday, Tuesday, very good traction, even through much of the day on Wednesday. And then the 1/4 point rate announcement, and shortly after Fed Chair Powell's comments about a no rate cut finish to 2023, and the market promptly gave about 230 basis points of gains back.
And we've seen that before, too.
We've seen that before. It was a similar interesting pattern, similar pattern. The market did regain its footing on Thursday and Friday, finished strong. As we speak, the S&P 500 and the Dow are up about 125 basis points on the week. The big winner for the week is the NASDAQ, up a little bit over 150 basis points and actually charging to the finish. The communications services sector, information tech, were the big winners on the week. The major laggards were real estate and utilities. We did make some portfolio changes, some additions over the course of the week to the US Equity ETF portfolio, additions to IJR, which is the S&P small cap 600, and a little bit more into QQQ, this following recent dollar weakness and possible signs that the market has begun pricing in a top in rates in the very near future. Maintaining cash and remaining patient is very important to us. It's served us well. Shaun, what are you seeing in the market with the market dynamics and fixed income?
Fear is definitely still driving the bus, as they say. So we talked about it last week. We talked about how fear is driving that risk-off kind of trade. Continue to see that this week. Yields lower. We have some Deutsche Bank issues possibly driving yields, especially on the short end, lower. We're going to put up a graph, and it's a great graph, and we talk about volatility all the time. So this graph is the one-day net change in yield on the 2-year Treasury, the 5-year Treasury, the 10-year, and the 30-year Treasury. And you can really see how much volatility is in those daily moves. And that's really what's dominating fixed income at this point. You know, we had Chairman Powell come out after the hike, tell the market they're concerned with inflation, and that's going to be their focus going forward. But short term, until you get past this banking sector contagion, you're going to continue to probably see moves like this in the Treasury space, and that's really going to dominate fixed income. As far as munis go, they've been kind of following Treasuries to a much smaller degree. We're still looking for opportunity in there. We talk about those 4% and 5% yields and how attractive they look. We like the long end of the muni curve right now. We think we're okay with the duration, and we think where you can buy 4.5%, even 4% on a very high quality bond, we think that just pays dividends going forward. So we like longer term tax-free bonds right here.
As Shaun had mentioned, we do have some sticky inflation, although the situation is certainly improving. We now have the headline issue with the banks, and we need to keep a careful eye on that. With that, Matt will be back next week. Have a restful weekend.